Hi, this is Lynn, and today we're going to talk to you about how do you read these darn reports anyway. A lot of times you get these reports, they're just a whole bunch of things on there and they tell you what you made and the expenses and the numbers, but really what does it mean anyway? So we have this company, which is a sample company. I'm just going to collapse this down. This is where we're going to start. This is the sample company. The basic way the profit and loss statement is read, you have the first section, which is your income. It's the money you made. You have the second section, which is a cost of goods sold, which we'll talk about in a little bit, but basically it's an expense. Note that you might not have cost of goods sold on yours, and that's okay. Not all books have it. The third section is an expense section, which is the cost of all of your expenses. And the last section is your other section. That's this section right here. And then finally, the big number at the bottom, which is the net income. So the profit and loss statement, some people mistake it for being, I made money, therefore I have cash, air quotes. And that's not true. The amount of money you have in your bank account is not the same as the profit and loss statement. In fact, there's many reasons why it's different, and we'll show you that a little bit further down the video. So right now, let's just talk about what is the profit and loss. On a bare level, most basic level, it is the amount of money that you made less the costs in your company, with a couple of exceptions. So this first piece is, this is your income. This is what you charged your customers. Now note, I'm going to double click into each one of these, and when I do, you'll see it brings up all of the detail for a particular company. So if you're wondering what's happening on that end, that's all I'm doing. So let's take this products, for example, and the installation and labor. So this particular sample company did installation and labor. They made $106,000, and in the products, just over $13,000. So the total money, or the total cash that they were available to receive, was $119,956.60. So if I were to look at your cash flow and how much cash you get, I should see something really close around that number. Now note that sometimes this number can be in cash you receive right away. It could be in your bank, or it could be in money that you're expecting to receive. So you have a customer that you bill and you get paid down the road. What's important about that income number is that you have to know what type of bookkeeping you have done in order to know if that number is an accurate number or not. For example, if you are having a cash-based accounting, and cash-based means that number is recorded when the money comes into your bank statement. That's different than if you have accrual-based accounting. And accrual-based talks about that number when you actually send your customer the invoice, regardless of when they pay that particular invoice. Cash-based versus accrual-based are very different numbers when they report back into your financial statements. And sometimes if you're looking at this particular number and you think, this just doesn't make sense, that's probably why. Because the numbers are being recorded at the time it hits your bank as opposed to the time you actually made the money and sent your customer an invoice. Little tip for you. It is far cheaper to have your books done on a cash basis, and therefore that tends to be the default way that it's done for most customers. So keep in mind this little section. Even though you see a number there, you have to understand what's behind that number. Now, the second section is the cost of goods sold. It means literally that. What is the cost of the goods that you sold? So in this particular case, if you can imagine, this installation and labor and products, this person bought $22,000 of job supplies. So in order for them to do this job, they had to buy job supplies. So they had to go to hardware stores and they had to buy screws and nails or wood or something that was directly related to a particular job. And that's what the cost of goods sold is. It is a direct cost that you can directly put to a particular company. After the cost of goods sold, you have this line called gross profit. Now, the gross profit is a number which reflects after you made your sales and you took off the expenses that were directly related to your sales. So, for example, let's assume this customer was building a deck. This would be the money they made from the deck, and they would have to buy the wood and the latches and all that stuff for it. This would be the cost of that. After they made that deck, they had $97,000 left. That goes into their business. It might be called the contribution. It's also another common term for gross profit. So now you have $97,000 to deal with. Of that $97,000, here's the breakdown of your expenses. You had $57.71 in automobile, $272 in bank charges, $327 in licenses, etc., etc., etc. So when your bookkeeper gets the copies of the receipts from you, they have to decide which category this goes into in order to properly record the expense. These numbers are then translated by your accountant into your tax return for reporting to Revenue Canada. So sometimes the classification of them is quite important. At the end of this, you get this number, which is basically the expenses, total expenses that you used, and the profit or net income that you pay is your gross profit minus all your expenses equals your net income that you're going to pay tax on. So if this sheet is so easy and straightforward, as we just talked about, it's a fairly simple concept, why does it feel like it doesn't align with your bank account? Well, there's a very good reason for that. Let me jump over to another sheet called the balance sheet. What the balance sheet does is it's a snapshot, and literally just a snapshot, it changes all the time, of your business at any given point in time. Now, one of the things you'll see in this snapshot is a loan. See this loan right here? If I was to go into this loan, you would see that they bought this truck and they got a loan for $40,000, and then they made payments on this particular loan. So there's a truck, and then they've made payments of $1,100 on this loan. Now, $1,100 is an awful lot of money, and if you take that over the course of a year, over 12 months, of course, that's going to be somewhere around just over $13,000. That's a lot of money to come out of your pocket. So if you think about this loan, because it's on the balance sheet, it has special rules. And the special rules that apply in the case of this loan says you cannot write off the entire value of your loan as an expense. And there's lots of reasons for it, which we won't get into here. But, for Revenue Canada purposes, you'll see nowhere on these expenses does it say loan. So even though you are spending $13,000, you don't get to write that off in here in real time. So think about this logically. Here's the money you made, minus what you had to spend to get that job done, minus all the expenses that you had to pay. You made $49,000, but $13,000 of that has been paid out on this loan. Let me just bring up that screen again. So if this is only 4 months, but if this was 12 months, it would be slightly over $13,000. So that $13,000 comes off of this money you spent, and it is not reflected on your profit and loss statement. That can be so confusing for business owners about where their cash is going. That's a really classic reason why. Because you're paying out money for items that are classified on your balance sheet, and you actually don't get to write them off in real time. The other place where money goes is in the shareholders loan. See, the shareholders loan is another place here. Now, normally a business owner owns a business, and sometimes you just take money out of the business with the anticipation you're going to pay dividends, or you just simply haven't set up the proper payrolls so that you can be paying Revenue Canada, and you're just putting money in your pocket. Either way, this shareholders loan is like a slush account. It's like if you took money out, that's where it's going to go. And eventually this gets a number. Now this particular number, in this case it's only $708, but if in most cases it's a lot higher. But what happens is this shareholders loan, you'll notice, is also not on here. So any money that you take without setting it up properly is not recorded on here. So here you had $49,000, you've paid out $13,000 for a car loan, and now you have another, in this case, $700. But if you can imagine, if you took $5,000 a month out of the bank, and you put that $5,000 a month into your pocket, and you paid your bills, and you just took it to the accountant at the end of the year and said, here, worry about it, Mr. Bookkeeper or accountant, then all of that money has been spent. So we have $49,000 minus the $13,000 that was already paid in the so we do the math here. We have $49,496 minus the $13,000-ish that we paid in truck loans, minus, let's say you're taking $5,000 a month. That's $60,000 of shareholders' money. Now you're $23,000 in the hole. So if you can think about it that way, your books say you made $49,000, and you're going to be taxed on $49,000, but the reality is you don't have that cash. So it's absolutely crucial when you're reading these profit and loss statements that they reflect the things that you really need them to reflect, and you understand that money that you are spending may not be the same money it is on this particular sheet. Once you get an idea and once you know exactly what those items are, it becomes a whole lot easier to budget for. So hopefully you learned something with this video, and if not, there's many more videos to see about balance sheets and the kind of things that apply and don't. So check out our video library. This is Lynn, and have a profitable day.